Welcome to today's webinar on Fixed Income Market Insight by Mutual Fund. This is our monthly series wherein we discuss perspectives and insights on the fixed income markets. Indian bonds continue to demonstrate their exceptionalism to global cues and maintain their positive momentum from January 2024. RBI released its MPC minutes wherein the members argue for the policy to remain committed to last mile disinflation with risk to inflation from food and geopolitical shocks remaining amidst a stable growth environment. To discuss more such insights, we have with us our head of fixed income, Mr. Anurag Mittal. Post his remarks, we will take up Q&A, and till such time, you can keep posting your questions on the link provided to you and to make the most of this opportunity. So without further ado, I will now hand over to Anurag. Over to you.
Hi, good day, everyone, and welcome to UTI webinar for the month of March. So like Sonal mentioned, it was a very eventful month. We had the budget in the February. We had the RBI MPC policy. So both very important events. So broadly, we'll be discussing what really went on globally as well as domestically and what it continues to mean for fixed income investors. I'll just be sharing my screen. So broadly, if you look at the global economic activity, this is on the left-hand side, this is JP Morgan Global PMI. The manufacturing PMI, which is the blue line, had bottomed out around somewhere around the end of 2023, which seems to now picking up. Same way in the services, it bottomed somewhere in between October 23 to December 23 and seems to have stabilized and again now picking up. While it is quite heartening that with the fiscal impulse, especially coming from the US, overall economic activity remains robust, but it is yet to be seen whether it becomes more widespread, and more importantly, whether this is a blip or the continued financial conditions which remain tight for most of the world bring some moderation in the activity. So we do expect that by middle of the year, most of the fiscal impulse should fade out, and probably both manufacturing and services should moderate. As we can see on the right hand side of the chart, the manufacturing sector had already started to bottom out and has been kind of flatlined for most of 2023. The services which went up for a while has again also started to slow. So we still think that economic activity is likely to remain moderate for the rest of the year, although it has we would say decisively bottomed out for now. If you look at the second leg of any central bank rate trade-off, which is the inflation, the Bloomberg Commodity Index, which is on the left-hand side, has been flat despite China trying to revive the economy, because overall Chinese demand continues to be weak. As we also saw in the previous slide, even the manufacturing sector is still recovering from the bottom in 2023. So commodity index, despite all the supply constraints, is still quite flat for most of the 2023, and it is continuing to be flat in 2024 as well. If you look at the global food prices from the UN FAO Food Index, on the YOY terms, it continues to be negative as compared to 2023. What would really be important for future food price trends would be how La Nina pans out for 2024. As far as the current forecasts are concerned, the weather agencies are expecting the El Nino conditions to play out at least till May, and the weather to remain dry till May. But they do expect weather to become better by June onwards, as India receives most of the rainfall between June to August. That will be the period the policymakers as well as the central banks will be watching out for on how inflation, especially food inflation, picks up for India. If we look at again global inflation trend, no major change from the last time. Inflation continues to trend downwards. The benefit of supply chain normalization as well as the base effect. It's largely, in fact, it's coming to close to 2 in the Eurozone and in Canada, but still remains way above 2% target in US and the UK. Nevertheless, given that inflation has fallen substantially and the real rate gap, which is the gap between the policy rate and the rate of inflation, has opened up materially for most of the advanced economies. The central banks are expecting rate cuts to commence probably in the second half of the calendar year 2024. While rate cuts may commence, but they may not go back to the previous low levels of pre-COVID till inflation also reaches to the target, which for most of these economies is 2%. So yes, there will be rate cuts, but probably slightly modest, and rates may not go back to pre-COVID era. If we look at the 10-year sovereign yield movement across key economies, so the lows that most of the bond yields made in the month of December 23, they unraveled in Jan, and they continued to inch up in February, as well as market participants reset their expectations of rate cuts from the central banks, as well as the timing of those rate cuts. So as we were discussing that, given that inflation is still way above most of the central bank's target, there was a slight, euphoria and probably in December that there will be substantial rate cuts in 2024. In fact, at some point of time, financial markets were expecting Federal Reserve to start rate cuts in March itself. That, as those expectations kind of waned, most of the bond prices also adjusted, and that's where Sonal talked about India's exceptionalism, and we will discuss that despite such substantial rise in yields across the world, India did not really participate, and India continued to hold on its own. So broadly, as we can see, yields went up 20 to 30 basis points across most of the major economies. So this is the financial conditions as we talked about, and the reset of market participant expectations. So as we can see on the right hand side of the slide, this is the market implied policy rate forecast 12 months hence. And if we look at in the beginning of January, market participants were expecting about 150 basis rate cuts in the 12 months, which has now gone to about 75 basis odd rate cut. So from a 150 basis points in the beginning of the year, now we move to 75 basis, as market participants realized that probably till inflation falls durably close to target, Federal Reserve will not be in a position to cut rates very drastically. Nevertheless, while rate cut expectations, have moderated, if we look at the financial conditions index, which is on the left-hand side, that has remained closer to the January levels, because as equity markets, as credit spreads, as overall, bond market liquidity has been quite benign. That's largely kept the financial conditions index largely close to early 2024 levels. Coming to India trends, we had the release of GDP and the GVA data. So the real GDP data for Q3, which is the quarter ending December 23, was released, which came at 8.4%, which was much above the consensus expectations of 6.5, 6.6%. If we look at the GVA data, which is the gross value added, which it came about 6.5%. Broadly, as we can see, and if you look at the difference between GVA and GDP, one of the larger differences between GVA and GDP is net taxes, which is GVA plus taxes minus subsidies. And as fertilizer subsidies went down in Q4 of 2023, that led to a strong pickup in net tax collections, and that's what really led to high real GDP. As we can see on the bottom table, the difference between, if you look at the real GVA and net taxes, it's the sudden spike in net taxes to 1.9% from 0.4% in September 23, which led to substantial pickup on the real GDP side. But looking at the composition of the GDP, what was really heartening was the continued pickup in the manufacturing sector growth. As we can see on the industry, in June, the manufacturing sector grew by 5%, in September 14.4, and there was an expectation that probably this will slow down in December, but that continued to show strong growth. If we can look at the even the financial services real estate sector, that also continues to grow quite well despite a high base, so that is also doing quite well. If we look at from on the gross value added side, even the despite the slowdown in public administration, as we can see, both on the trade, hotels, and the financial real estate, overall economy is doing quite well. So we also had the release of household consumption expenditure survey by Ministry of Statistics. So this survey is done every 10 years, and it is quite important because it sets the tone for setting up of weights for consumer price inflation, which is broadly what RBI targets. So broadly, the results of this survey have a direct bearing on what RBI, reaction function, because that's what largely determines the weights which go behind this CPI construction. So as we can see, broadly, this is a very intensive survey. It is done across households in rural as well as urban areas, across more than 2.5 lakh households, and done at various income parameters as well as consumption parameters. So what we try to do is we try to discuss the broad parameters which have a bearing on really how growth, inflation dynamics are playing out in both the rural and urban economy. So as we can see, the consumption growth has declined between 2011-12, 2022-23. Broadly, as we can see, the CAGR for rural expenditure has grown about 9.2% compared to 13.8% for 2005-12, and for urban, it's about 8.5 compared to 13.2. I mean, these are the trends that we have seen in when we were looking at GDP as well. That largely GDP has been growing from due to high government spending as well as high manufacturing rather than consumption. Nevertheless, it's quite heartening to see that rural sector is doing relatively better. So probably the gap between the expenditure of urban and rural will kind of narrow at some point of time. More importantly, from inflation management perspective, as we can see, as households are doing better, they are becoming well off. The spending on food and beverages as a percentage of total spending has been declining. So as we can see, if you look at the right hand side of the table, the share of food, which was about 60% for rural India in 2000, has now slipped to 47.5%. Same way for urban, which was about 48% in 2000, has been steadily declining and now at 39.7. And if you look at the cereal percentage of cereal as well, it's come down drastically from for urban from 12% to 4.5%. Same way for rural, from 22.2% in 2000 to 6.92%. So this has a very positive implication on inflation. So if the current weightages of housing consumption expenditure survey were to be applied on the current inflation series, inflation could be lower by 30 to 40 basis points, assuming the current weight of rural urban expenditure were to continue. So that again is quite helpful, and probably for FY 25-26, when the new series, if it gets applied, that could help headline inflation to go down. Coming to again the inflation trend, as we can see, the core inflation continues to trend downwards. because of significant softening in commodity prices. We saw during when we were discussing the Bloomberg Commodity Index how commodity indices have largely been flat for most of 2023 and 24, which is now largely also reflecting in core goods inflation, which has continued to remain quite soft. Uh, in fact, in the uh, manufacturing firm survey which RBI conducted also pointed out that core inflation will continue to remain on the softer side. What really has been, been concerning RBI is the volatility in food inflation. So as far as current trend is concerned, like we have been seeing that central government has been intervening in both cereals as well as other fruits and vegetables, and they so probably the impact on headline inflation has not been very pronounced for India as it has been for some of the other emerging markets, as the major impact has been borne by fiscal. If we look at the current buffer stocks for cereals, as well as the proactive supply side interventions, we think that food price pressures will remain in check. Also, it will be important to see how the outlook for monsoon pans out for the rest of the year. Normal monsoon will bode quite well for inflation outlook for next financial year as well. If we look at the credit deposit growth, the non-food credit growth, excluding HDFC, because it was a addition to this year, is still hovering at 15% plus, while deposit growth is close to between 12 to 13%. And because of this gap between deposit and credit growth, we are continuing to see tightness in the money market curve as banks try to raise deposits to support the strong credit growth. As we can see on the liquidity side, after the Fed policy, there was a lot of concern amongst market participants whether RBI will intervene on liquidity to ensure that the MIBOR rate stays close to the policy rate. As we can see at the fag end of the February, RBI has been intervening with fine-tuning operations. That is, it has been announcing VRRs as well as VRRs to ensure that there is adequate liquidity in the banking system at most points of time, as well as to ensure that there is no sudden undue shock on the overnight rates on either side. And hence, we can see in the last 30 to 40 days, overnight rates have stabilized close to the policy rate of 6.5%. If you look at the fiscal trend, we have discussed the budget before, so I will not get into very great details for the budget, but broadly the trend remains quite healthy. As we can see, direct taxes continue to grow very well, especially income tax, which is growing at 27% YOY, and corporate tax, which is growing also at 20%. If you look at the net tax revenue of FY24 RE, which was about 81% of the estimate, which is quite healthy compared to the same trend rate in the 10 months ending FY23. If we look at the expenditure side as well, that contracted YOY because of lower capex, although on FITD terms, it continued to grow about 6%. On the trade side, as we were seeing the softness broadly in the economy, we talked about weaker private consumption. That's also reflecting in the lower non-oil imports. If we can see, lower non-oil imports fell from 43.3 billion to 37.8 billion, and that's resulted in lower trade deficit falling from 19.9 to 17.5 billion. So while it is concerning from a point of view of weaker consumption, but overall, if we look at the trade balance, it is much healthier compared to 2023, and probably it will be should be well manageable in FY24 as well as FY25. In fact, in FY25, with these trends and with the inflows expected due to the bond index inclusion, in fact, the balance of payments accounts for India could even turn surplus, which is quite positive even from the currency perspective. If we look at broadly the shape of the curve for this broadly the curve remains flat as participants are expecting rate cuts to start in the calendar year 2024. And typically, when market participants are expecting rate cuts, the preference becomes towards a slightly higher duration. That's largely like the flattening of the yield curve. As we can see, at specific tenors, if you look at, for example, uh, broadly 1 year, 3 year, 5 year, most of the rally was seen in government bonds. If we can see, for example, on the 10 year continued to rally with 10-year GSEC closed at 708. If you look at the 10-year AAA, also moved about from 5 basis lower from 768 to 763. If you look at 1 to 3 year, which was slightly higher because of heavy issuance by banks to take care of their strong credit growth. So it's not really the liquidity, but strong credit growth from the banking system. And hence there is a pressure from the banks to raise deposits. And that's largely leading to some tightness in the 1 to 3 year space. But if we broadly look at the 5 to 10 year space, which is not really anchored by the near term liquidity pressures, but largely market participants' view of the terminal interest rate that has been anchored. So this is quite again remarkable for India because as we saw in the one of the previous slides, global yields have went up by 20 to 30 basis points in the month of February, and despite global yields went up, going so high, Indian yields have in fact come down on the long end. So that reflects the constructive view that market participants have on inflation as well as on strong demand due to bond index inclusion. So broadly, what the outlook we have is that given, one, the view on growth for most of the economies is still quite robust, and there is an uncertain outlook on inflation as it has been for the last 12 months. Probably it will not be very helpful to look at central bank forward guidance as central banks will not be able to commit themselves to a predetermined path. What really matters for bond market is the view on the terminal rates, which we still think is quite constructive, given that inflation is expected to average around 4.5% in FY25. The base case for 50 to 75 basis rate cuts still remains quite strong. If we look at the current shape of the yield curve with 3 year bonds trading around about 780 and inflation expected to be around 4.5 for FY25. The high real yields today, they present a suitable opportunity for patient investors to experience high approval as well as possibility of participating in capital gains as rate cycle turns. So this is quite important because we think from the period of December to February, there was a broad-based global, rally in interest rates because as the central banks pivoted, market participants kind of formed a view that at least we are not seeing any rate hikes anymore, but we are likely to see rate cuts from here on. What matters is the quantum of rate cuts, the timing of rate cuts, etc., etc. But when, as an investor, when we are, kind of assessing what funds to allocate to, we also need to see whether we are looking at a cycle of deep rate cuts or modest rate cuts. Given that we are looking at a cycle of modest rate cuts, probably the moderate duration, which is typically between 2 to 4 years, is more suitable for investors who are looking at 12 months kind of investment horizon because typically curve tends to steepen in periods of shallow rate cut cycles. Hence, we are recommending investors to consider allocation towards moderate duration products such as short-term corporate bond banking PSU, whereas investors with 6 to 12 months investment horizon can consider allocation to cash management products like low duration money market, given that there is a considerable gap between overnight rate and money market rates. So that was it from my side. Thanks a lot, and we are happy to take questions on the presentation of any other doubts that we have. Thank you.
Thank you, Anurag, for sharing your insights and outlook on fixed income markets. So the webinar is now open for Q&A, and I invite the participants to share your questions in the link provided to you. In the meanwhile, while we wait for the questions to queue up, I'll begin with the questions that we have already received.
Sure.
Yeah. So the first question goes like, with Q3 GDP numbers coming at 8.4%, high frequency indicators are pointing towards good performance in Q4. So what are your views over here?
So we do think that the momentum that the Indian economy is experiencing, especially on the investment side, both on the private as well as on the government, is expected to continue for next couple of quarters at least. So there is a very strong momentum that we are seeing because of very high and strong capex by the government, and that is in fact further strengthens our belief that possibly the rate cut cycle could be quite shallow for India because we really don't have a growth problem as some other parts of the world. For our for us probably growth is still expected to be above 6% and plus even in FY25, at least in the near term, and hence RBI is really not in a pressure to cut interest rates given that the growth outlook is quite robust.
Sure. So the next question goes like, the overall trade deficit has improved by 37% from 112 billion in April to Jan of FY23 to 70 billion in April to Jan of FY24. However, the global trade environment remains uncertain because of geopolitical issues and a general slowdown across developed economies. What's your prognosis on India's path to fiscal consolidation on this backdrop?
So, given that globally there is a uncertainty on how uh, global trade is expected to perform, that is why we have a slightly moderate view of growth compared to RBI. That is why we said 6% growth rather than 7% growth, which some of the private forecasters are expecting. And on the fiscal side, we believe that ultimately, fiscal deficit is a function of one, expenditure, and secondly, tax policy, which comes from high growth. Given that we do expect growth to moderate, probably the rate of tax collections in FY25 will not be as strong as it was on the in FY24. But having said that, this year the government will have the benefit of higher WPI as well. As we know, during the last year, since WPI has been largely flat and close to zero, the deflator has been quite. So this year probably India will experience a higher nominal GDP, and hence the tax collections should be overall strong. And in fact, they could be higher than the very conservative budget estimates. As far as the expenditure side is concerned, as we have seen this year as well, government has been committed to its expenditure as well, and hence we do expect fiscal for FY25 also to follow the consolidation path that FY24 has been following.
Sure. The inflation has continued to decline this month as well. The downward trend in January softening to 5.1% from 5.69% in December 2023. However, RBI has continued to show its concern on the food price shocks going ahead. So, how do you think the inflation numbers looks like in the coming future?
So we have a very constructive view on, like I said, on core inflation. So inflation is expected to remain well behaved and should remain anchored to around 4% as commodity prices remain well anchored. One of the concerns that RBI has raised and which is difficult to predict is the volatility in food prices due to global supply chain shocks as well as any disruption in the monsoon pattern. So probably any upside risk to inflation really stems from either a global food supply chain shock, or it can come from if monsoon pans out to be weaker than expected. So probably we, as of now, assuming a normal monsoon, we do expect that inflation should average around 4.5 to 4.7% for FY25. One, because of the very strong base effect of FY24. So that itself should lead to slightly moderate inflation in FY25. And also, like we were discussing even on the first slide, we do expect global economic activity to remain moderate. So as long as global economic activity remains moderate, we really don't expect core inflation also to pick up very meaningfully.
Sure. So on a follow-up question on the inflation itself, how far do you see there could be an impact of farmer protest on the food prices?
It's very, I would say, very theoretical right now because there is no agreement between farmers and the government on any particular food crop. There is no disruption to the supply chain as of now to the local agriculture markets. So we need to see the modalities of how what really governments and farmers agree on to see the impact on food prices.
Sure. Moving on to the next question. How is the tightened liquidity from RBI going to impact investments in fixed income funds at the short end of the curve? Funds like liquid funds, money markets.
Right. So we do think it's a misnomer that RBI is keeping liquidity tight. It's largely the government cash balance that is leading to slightly tighter liquidity because as the tax collection goes into the government account, it basically goes out of the banking system to the government, and as and when the government starts to spend the tax collection, that liquidity comes back into the system. That was also highlighted by the RBI in the August policy as well as in the October policy. And as we can see, RBI has been repeatedly intervening in the in the overnight market through VRRs as well as through VRRs to keep to provide liquidity to whatever the productive needs of the economy. I think the difference and why money market rates have been tight is the gap between the credit deposit that we discussed. Because of very high credit growth, banks are under a slight pressure to raise deposits, and typically they have been raising bulk deposits and as well as certificate of deposits, which has led to tighter rates on the money markets side. And we believe this is a great opportunity for investors who are looking from a more 6 to 12 months kind of investment horizon. That today, if you look at the yield curve, 1 year PSU bank CDs are trading between 765, 770, 775. So this is the kind of range. And they are also looking quite attractive compared to other traditional fixed income instruments. So hence we are suggesting to investors that one, the reason behind this tight liquidity is not just RBI but the government of India cash balance, which should start to get depleted as government spends probably in end of March and April. So investors who have a slightly longer term horizon can look to invest in money market low duration funds, which should benefit from as the government spending starts to pick up in the next quarter.
Sure. Thanks, Anurag. So the next question is on the household consumption expenditure survey, the data which was released by Ministry of Statistics and Program Implementation for 22-23. So you have also covered this survey aspect during your updates on insights on during the webinar. So this data for 22-23 indicates that the income levels of urban and rural households have risen since the last survey, which was concluded 11 years back in 2011 and 12. Since then, the rural households are showing a sharper growth in spending, but it also indicates that the gap between the rich and the poor is widening. So what are your views over here?
So from a bond market perspective, I think basically what it really is implying is a K-shaped recovery where I would say the lower earning groups have been slightly distressed, and on the the higher earning groups have they have seen a steady increase in their income. Uh, from a bond market perspective, it is slightly, I would say undesirable, because what broadly it means is that the growth, drivers are not really durable. We are largely experiencing a cyclical growth, and as more distress rises, maybe in typical cases, government sometimes needs to step up and intervene in terms of more fiscal transfers. And that, from a long-term perspective, is not very healthy from a fiscal side. But as we can see in the last, 2-3 years, government has been undertaking a lot of capex related expenditure, which will probably lead to higher employment as well as higher income levels on the bottom earners as well. And that, from a medium term perspective, we do expect this K-shaped recovery to kind of balance out slightly better. Thanks.
Surely. Following up question on the survey itself, do you think this survey may lead to some changes into the basket that goes for the CPI inflation numbers projections?
Sure. So as we discussed during our update, so broadly, this survey is used to impute the value or the weights of the CPI basket. And as the share of food, expenditure has been going down since last, four surveys, we do expect the share of food also to go down in the final CPI basket. So it also depends to what extent the government takes into account the survey. But going by historical patterns and going by the current weights in the survey, typically we do expect the share of food can go down by 4 to 5%, which can result in 20 to 30 basis reduction in headline CPI over a period of 12 months whenever the survey gets implemented.
Surely. The next question goes like, no, there has been some disruptions going in the Red Sea. So how far do you see it can impact global economies and especially the supply chain dynamics?
Right. So the disruption at Red Sea has led to an increase of about, I would say, 100% in freight cost for most of the producers. But the good thing is, if you look at total global GDP, overall logistics forms, and especially shipping, forms a very small component of total goods cost in the world. So typically it ranges from 2 to 5%, and on an average it's about 2.5%. So broadly, even if, let's say, the current trend continues, it adds up to 20 to 30 basis in headline inflation. Of course, if the situation were to escalate further, then it can lead to severe disruption and the higher inflation. But as things stand today, we do not expect any major disruption. If we look at oil prices also, despite such a high disruption in the Red Sea, oil prices have not really meaningfully. So that also shows that the demand continues to be weak, and probably we should not see any major impact as long as the disruption remains contained.
So the next question here is, what are your thoughts on the spread compression between the corporate bonds and G-Secs going forward?
Right. So I think we do believe that the spread between government bonds and corporate bonds could continue to remain wide in the near term, and we think that government bonds could outperform corporate bonds in the near term. The reason being of twofold. Typically, in a rate cutting cycle, government bonds tend to react faster. Same, just like they react uh, unfavorably when rate hikes happen. They also react the faster, typically in a rate cutting cycle. Secondly, the demand supply dynamics for government bonds has improved drastically, and hence we do expect that at least in the next 3 to 6 months, government bonds should continue to do well compared to corporate bonds. If we look at, we are still expecting about 20 billion odd inflows in government bonds, in the next financial year. So, and if you look at corporate bonds, given the strong, capex spending which is happening both on the PSU as well as the private sector, we do think the supply of corporate bond could remain there for a long time, and hence we do expect these spreads to sustain.
Sure. The next question, while you have covered a lot of it during your initial talks, so the yields are quite high at this point in time. Do you suggest to the investors considering this? Is it the right time to enter fixed income markets? Those who have not entered the market yet, and those, what would be your advice to the existing investor base?
Right. So investors who are looking to enter the market, I think we need to keep in mind a couple of things. One, we are expecting a shallow rate cut cycle of 50 to 75 basis points. We are not expecting a deep rate cut cycle because the outlook on growth is still quite positive, and outlook on inflation is still quite uncertain because of volatility of food prices. Given that we are expecting a shallow rate cut cycle, we think that rather than going for very high duration products, investors can consider moderate duration products such as short-term corporate bond, banking, PSU kind of products, which one are offering very reasonable approval. Also, they're also giving an option to investors to participate in capital gains whenever the rate cut cycle starts. The benefit of this strategy is given that globally things they have panned out in the last 12 to 18 months. In fact, even during last year, at the same time in 2023, especially when there was a regional banking crisis in the US, there was expectation that rates will have to be cut soon and rates will have to be cut aggressively. And as the year panned out, things didn't really happen in that direction. The same way, given the uncertainty that we are facing today, probably from a risk reward perspective, the absolute accrual that we are getting in these moderate duration products is quite quite robust, and hence we do expect that from they give us sufficient space to participate in capital gain as well, rather than very high duration products, and hence we are recommending investors to consider these products. For investors who are already invested, I think if we look at last 12 months, markets have largely been flat. So investors have been largely earning the accrual in the products that they have been staying in, and probably in next 6 to 12 months when the rate cut cycle starts, that is when probably they can expect some mark to market benefit as well.
Sure, Anurag. Also, there are a lot of investors who park their surplus funds into traditional or conventional investment avenues like bank FDs or savings account or some other ways. So, what are the options that are available to these set of investors? What mutual fund schemes that are available, and what is your advice to such investors? How should they can get benefit by investing into fixed income funds, and what kind of strategies they can use for maybe systematic transfer to their other schemes? So, over to you.
Right. Thanks, Onil. So broadly, an investor who's investing in traditional fixed income products is looking for a stability and predictability in their return profile. And hence, we believe that such investors should stay away from very high credit risk or high duration risk. Largely, the investors should look to allocate bulk of their fixed income allocation to moderate duration, high credit quality products which do not carry any major credit risk or any major durations. So, for example, for in UTI stable, we can recommend the short-term fund or the corporate bond fund or the banking PSU fund, which are all moderate duration as well as high credit quality products, where investors can consider looking at compared to other traditional fixed income instruments.
Sure. Thanks, Anurag, for that answer and for taking up all the questions in today. So I know we have some time left, but because of some emergency, we would like to. So there is something which has come up, and that is why we would like to keep it a little short today. Thank you, participants, for joining in today's webinar. Your active participations and thoughtful questions make our sessions very engaging. We would like you to share your feedback on the link provided to you. Special thanks to you, Anurag, for sharing your insights. And with your closing comments, we can conclude today's webinar.
Thanks a lot, Sonal, and thanks a lot for joining in. It was wish it was very helpful to you, and please do share your feedback. And look forward to see you in the next financial year. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.